Hi, and welcome to episode 5 of Behind the Numbers, a podcast for accounting students. I'm Dr. Amanda White, and today we'll talk about a number of interesting stories that have come up in the news that are useful to accounting students. So let's start with our first story of the day. Our first story was from last week, where Dick Smith Foods has made the announcement that its potential to continue as a going concern might be limited. So the concept of going concern is that a company will continue on in the future, and we prepare their accounts under the basis of going concern, that they will be able to sell goods and pay their debts as they fall due. Now, Dick Smith Foods is an Australian-owned retailer who sell Australian-only owned and manufactured food products, and all their profits are donated to charity. However, they believe that their days are numbered, according to Dick Smith, because those suppliers that they rely on to provide them with Australian-made produce are being slowly either purchased by international conglomerates or being forced to close down when they cannot compete with cheaper imports. Dick Smith gives the example of moving one operation offshore when they could save 5 cents on every dollar. So the company has been around for about 12 years, but has commented that he thinks the days are numbered. And remember, going concern is about the organization's ability to pay its debts as they fall due. One thing that we cover in accounting and in auditing is that we need to look at an organization's ability to obtain products for sale. And if companies are disappearing and Dick Smith cannot purchase the goods that it does need to sell to be able to pay its debts, then the company may not be a going concern. What are the implications for that? Well, the auditors, of course, need to consider whether the company will be a going concern for a period of 12 months from the date of their audit report. So they do need to look forward at estimates of sales and cash flows to determine whether Dick Smith will remain a going concern. Our second story of the week is about ASIC. So ASX listed companies are currently required to follow continuous disclosure practices. This means that when information is released, they want to release information that is share price sensitive, that information should be made available to everybody at the same time through an Australian Stock Exchange announcement. Instead, however, ASIC is investigating the possibility that companies are making private analyst calls. So either prior to releasing information to the market, they're having private meetings with selected share analysts, or they're providing additional information to analysts besides what is being released in publicly made announcements on the Australian Stock Exchange. This lopsided release of information is actually called information asymmetry. So some people receive more information or information first, and then that allows them to trade on that information for their own financial gain. Now, within the Australian situation, receiving information before others or having access to private information and then trading on that publicly is called insider trading and is illegal under our market rules. So the Australian Stock Exchange has announced its investigation, and that investigation is going to be market-wide. They're talking about investigating analysts, companies who are making these disclosures with expanded information to some analysts, and brokerage firms. They're also going to be looking at share price data and analyst reports to determine whether there is any trend. One reason why they're investigating is that the market should be fair for all. So we want to have some form of market efficiency. So we'll need to stay tuned to ASIC and see what happens with their investigation, but it certainly is important for those who are valuing companies. Our third story this week is Holden. So in the United States, General Motors, which is the parent company of Holden, have recalled millions of cars over safety concerns, and that recall has spread to Australia, with Holden recalling 42,000 Commodores for a possible seatbelt fault. And this is essentially every new Commodore sold since May 2013. So in terms of accounting issues, one of the big things that accountants and auditors are going to need to consider is the possibility of increase in warranty and repairs expense. If you look at Holden's financial statements after we've repaired these 42,000 seatbelts, in these cars, we should expect to see an increase in the warranty and repairs expense and a potential increase in the future provision for warranties in case there are any later recalls or recalls of other models that might have the same issue. In the United States, General Motors is being investigated for potentially not releasing information to the public and recalling vehicles soon enough, putting public safety at risk. So there is also some criminal elements here if companies are intentionally covering up a fault and not recalling vehicles. But there's no instance or there's no indication of that here in Australia with Holden, but that certainly is a subject of a big investigation in the United States with General Motors. Now, our very last story of this week is the NRL investigation over possible salary cap irregularities at the Brisbane Broncos. So back in one of our previous episodes, I interviewed Dr. David Bond about accounting in sport and how accounting plays a really big role because the firms or the clubs themselves have a salary cap, a maximum at which a pool of money at which they can pay their playing talent over a financial period. They have a complicated salary cap formula that includes basic salaries, match fee payments, and payments from third parties. An anonymous tip was made to the NRL about the Broncos potentially breaching restrictions on player payments for third-party arrangements. And this is where a player receives a payment from a third party not related to the football club. So they're not a sponsor of the football club. This is a separate arrangement, but still comes under salary cap in particular circumstances. So how does the NRL investigate in this particular instance? In this particular instance, the NRL has its own auditors. So they have salary cap auditors who audit all of the clubs, and the Brisbane Broncos have announced that they're opening their doors willingly and willing to work with the NRL salary cap auditors to investigate the allegations. So just like a financial statement audit, there needs to be some suitable criteria. The NRL has its salary cap rules. The auditors will need to collect evidence to determine whether there have been a breach of those rules and then report back to the NRL to determine what fines are required if there has been a breach. Now, there are no implications here at this stage that the Brisbane Broncos have been engaged in a systematic rorting and fraud of the cap, as we saw a number of years ago with the Melbourne Storm, but expect to see more released on the investigation soon. The Brisbane Broncos are a publicly listed company and as such are subject to the ASX's continuous disclosure requirements. So I'm Dr. Amanda White. Thanks for listening in this week. That's all the accounting news that we have for you, but I'm sure there'll be more news items to talk about next week.